I think it's 4 minutes past 4, so probably let us kick off. It's exciting to see there are probably about 60 odd people on the call. Good afternoon, everyone. Assalamu alaikum. Welcome to our webinar around internal controls over financial reporting for insurance companies. This is quite a topical topic these days with the new circular, or the clarifying circular, if I may say, which came out from the Insurance Authority. There are a number of questions we also had, and we have been taking clarifications from the authority, and we thought it would be useful to share some of our observations with this group. Please do try and ask us questions. We will be talking, or at least sharing, our knowledge around this space for the next 60 odd minutes, and we'll leave 30 minutes for Q&A at the end. Do make our lives difficult, ask as many questions as possible. With me today, one final thing, please don't worry about taking any notes. This deck of the presentation will be shared with you later on. And obviously with that, you'll have number of all of our contact details as well, so you can then connect with us separately. So look, with that, let me just let you know who is with you today. So my name is Abbas Basrai. I'm a partner in KPMG Lower Gulf. I look after financial services. I've got over 20 years of experience, having worked in the UK and recently moved. I've moved here about 8 years ago to the UAE. I focus across banking, insurance, and asset management. Today, obviously, the topic of conversation is insurance. With me, I've got two of my esteemed colleagues, Mariam Zaman, who's a partner, and she heads internal audit for financial services. Mariam's got over 15 years of experience, having worked in the US and the UAE. I think the reason I wanted to highlight US specifically is because ICOFR, or internal controls over financial reporting, it might be a relatively new concept as far as UAE is concerned, but it's not a new concept from a global perspective. And Mariam's had quite a bit of experience when she was working in the US in this space, so she'll probably share some of her knowledge as we go along. She does have a lot of experience working with insurance companies, and I would like to believe a lot of you attending the call would know her and at least recognize her. The second person is Siddharth Behel. Siddharth is the partner with KPMG Lower Gulf and is the solution lead for internal controls. Siddharth has over 20 years of experience. Like I said, he leads our internal audit, risk and compliance services for KPMG Middle East. He's a qualified accountant from India. He's worked both in India and UAE, and he's also done his CPA from the US. One additional point to highlight, because ICOFR came out here in the UAE about 3 years ago, and Siddharth will talk a bit more about that from the Abu Dhabi Accountability Authority perspective. Over the last 3 years, Siddharth specifically has been involved in working with at least 75 to 100 companies, not just in the UAE, but globally, in supporting and helping them with their journey around ICOFR. So with that, I think let me just share with you what we are planning to cover today, which is the agenda. Now, look, as mentioned, ICOFR is not new, right? It's been introduced globally with SOX, I think, back in 2002. And since then, in Europe, and very recently here in 2006, new standards. So it's something that's been there in the past, but then move on to the understanding of the specific internal audit, insurance authority circular requirements. There are a few topics there which are quite important to understand because the circular came out initially in 2019 and there were some clarifications in 2020. Look, I think it's one important thing to highlight is don't just look at this as a compliance with regulatory requirements. I think if you do implement ICOFR properly, there are a number of benefits, which Siddharth will talk about later on as well, but things like enhanced governance, so you'll get process efficiencies, you can prioritize the internal controls which are high risk, you can introduce some automation, and more importantly, identify certain control weaknesses and what the potential root causes are, so that your financial reporting process is robust. We'll then move on to the the introduction of COSO internal control framework, and finally just breaking down the journey, the ICOFR journey. We will at that point stop and open it up for Q&A. Do keep the questions coming in. We are constantly monitoring the chat box, and we've specifically left 30 minutes at the end to answer, if not all, at least try and answer majority of your questions. With that, let me hand over to Siddharth, who will talk us through the similar enactments across the region and the globe.
Thank you so much, Abbas, and thank you to everyone who is with us today. So starting off with giving you a bit of a background in terms of what are the similar enactments we've seen across the region and the globe. So we've seen a number of similar enactments globally in the last 20 years, the earliest being in 2002 in the United States. This was actually an outcome of the Enron scandal in 2001, I think, which a lot of you may actually remember, and a number of other financial reporting scandals as well in companies such as Xerox and WorldCom, which happened during the same period. This had led to actually the establishment of the PCAOB to oversee the work of the auditors in the United States, as well as the passage of the Sarbanes-Oxley Act, or SOX, which is referred to in short, which required both the management and the auditors of US listed companies to sign off on the internal controls on financial reporting. In 2007, SEC made further amendments in the requirements of the law and also then specifically endorsed the Committee of Sponsoring Organization, or COSO as it's called in short, their internal controls integrated framework, right? The SEC also identified the guidance on assessing controls published by the Canadian Institute of Chartered Accountants, as well as the Turnbull report published by the Institute of Chartered Accountants in England and Wales as examples of other suitable internal control frameworks. The SEC had also then emphasized that management must be actively involved in the internal control process and may not delegate its responsibility to independent auditors, because I think at that point, a lot of companies were trying to sort of get the external auditors to do the work instead of the companies themselves. Then moving on to 2014, 2013, we saw the European Union then passing several audit reforms, right? Some of them was to around mandating the auditor rotation, as well as putting in stricter controls over the kind of non-audit work which was permitted to be performed by the auditors. At the same time, in 2013, we had seen in India, for example, the new Companies Act, which had come out, which also covered various aspects such as internal financial controls, auditor rotation, as well as mandating compliance with all applicable laws. Back in UAE in 2017, we saw the Abu Dhabi Accountability Authority, or ADA, pass Resolution 1 of 2017, which mandated all subject entities, which are basically entities where the Abu Dhabi government owns majority of the shares, to require their auditors to provide a separate opinion on internal controls over financial reporting. The resolution also required auditors to comment on compliance with laws having a material financial impact. The ambit of ADA has recently been expanded now to cover companies where the Abu Dhabi government holds 25% of or higher. So a larger number of companies in Abu Dhabi and across UAE are now being asked to comply with the ICOFR requirements. Then coming to 2019 is where we've seen the Insurance Authority releasing Circular number 21, followed by the recent 2020 circular giving the further clarifications on the requirements, now asking for a separate opinion from the external auditors on the effectiveness of internal controls or financial reporting. This is now applicable to all insurance companies registered and licensed by the Insurance Authority. Jitin, if you can move to the next slide. Right. We just wanted to do a quick comparison on this slide with Sarbanes-Oxley or the SOX requirements, which several people are familiar with, and the IA circular. So a quick comparison, basically, if you look at it, the first column represents the respective laws which make these reporting now mandatory. The next column depicts the reporting bodies as well as the standards applicable for auditors. Under Sarbanes-Oxley, it's basically the PCAOB, and the auditing standard 5 governs how the audit is conducted and the reporting is done by the external auditors. In UAE, what we find is the auditors follow the International Auditing and Assurance Standards Board, as well as report under the International Standards of Auditing. Right? Then if we move on, as mentioned earlier, SEC has endorsed COSO and as the internal controls framework, and this is the primary framework which is adopted by a majority of companies globally. So this is probably the best known framework, whether when it comes to the auditors as well as the shareholders and investors, right, being aware when you say the company has an internal controls framework and you mention COSO, they actually understand what exactly the company is doing, right? We'll talk about the framework in more detail in subsequent slides, which Mariam will take us through. What we're also looking at is recommending the framework and COSO framework for complying with IA circular as well on ICOFR, and also to mention, so most of the companies in UAE under the ADA resolution are also following the COSO framework, right? So again, so one is the framework, and then is basically the methodology that companies need to employ or adopt for implementing the framework. So here also we are recommending the same methodology which is being used for SOX and ADA and globally, right, can be used for insurance authority requirements as well. So largely it's a 7-step process. We'll go into that in more detail, but basically it covers everything starting from how do you plan the engagement, how do you scope it out, what is the documentation which is required, right, what kind of testing needs to be done, how do you go about remediating the gaps, reporting internally, and then finally how the external auditors reporting is done independently. So that's on this slide. If we can move to the next slide in terms of understanding the IA circular requirements in more detail, right? So basically what the IA circular states that as part of the year-end exercise, external auditors are now required to obtain an understanding of the internal controls relevant to the audit and to express an opinion on their operational effectiveness, right? So this is going to be a second opinion that the auditors need to start giving starting 2021, right, in terms of the operating effectiveness of financial controls. Now, looking at why or what was the objective of the circular and what is the spirit of the circular. So what the IA is trying to achieve is firstly improve the quality of financial reporting as well as compliance across insurance companies. They're looking to enhance the operating model to ensure efficiencies. They want to assist companies in integrating with the dynamic environment by putting more robust processes and controls in place, looking at how to get insurance companies and the insurance sector in UAE to incorporate global best practices, and then finally increasing the reliability of the financial information, which in turn would boost investor confidence and attract greater investments in the sector, as well as enhance policyholder confidence. And finally, to protect the interest of all stakeholders, whether they're employees, they're investors, creditors, bankers, or policyholders, etc. Right. So that's the main purpose that IA has behind this circular. Moving to the next slide. So in terms of what the Insurance Authority has also done with the clarification that they've issued in 2020 is to lay out the roadmap for what companies are required to do from now, which is in 2020, till the end of 2021 and beyond that as well, right? So as a first step, companies need to establish the ICOFR framework, which is either adopt COSO or a similar global well-recognized framework. Then they need to review the design and operating effectiveness of their controls. We'll cover these two terms in terms of what we mean by design and operating effectiveness in later slides. But they need to first do that for the year ending 2020. The next step is then to communicate the gaps identified to internal control owners. Also, Insurance Authority needs to be provided with a report by April 30th, 2021 on the results of the management assessment, as well as the key gaps noted. So this is the first milestone that where we actually have something external going to the Insurance Authority. Thereafter, management would be required to remediate the gaps noted for 2020, as well as retest the controls for 2021, because right now you'll be testing them for the current year. So you need to test them for the next year to ensure any changes in processes or controls have been captured and updated in the documentation, and also to ensure that the controls continue to work effectively in 2021 as well. The final step towards the end of 2021 would require then the external auditors to come in independently to assess the entire internal controls framework and provide their report as on 31st December 2021. Steps 4 and 5 will basically repeat in each subsequent year, where management will do the testing followed by the external auditors testing and reporting. Jitin, we can move, right? So the next section in terms of looking at the benefits of implementing ICOFR, while I'd earlier covered the objectives that the insurance authority had for implementing ICOFR, some of the other benefits to companies have been listed on this slide. So adopting the internal control framework will help to enhance the overall governance of insurance companies over a period of time. What we have seen, the framework does take anywhere between 2 to 5 years to get fully implemented and to get the full benefits from the implementation. It also results in increasing an awareness of internal controls and processes across the organization, and which obviously leads to better trained and better aware process owners. One of the things what we've seen is that companies often realize that the IT general controls is an area which needs a lot of work and needs to be greatly enhanced. So this is something which probably during the next year is what a lot of companies will need to work on. There are also aspects like fraud risks and fraud controls which need to be implemented, which also get strengthened over a period of time. Also, this helps management to identify critical areas where they have material process and control weaknesses and allows them to fix these in a systematic manner. So it's not like you're just haphazardly going across finding weaknesses and fixing them, but adopting this methodology actually does that in a very systematic manner. And over a period of time, companies move towards more efficient as well as automated control environment, right? With that, I want to hand over now to Mariam to take you through the next two sections. Mariam, over to you.
Great. Thank you very much for that, Sid, and thank you everybody for joining our webinar today. So in the next section, I wanted to discuss the various elements of the ICOFR framework that you need to consider implementing in order to comply with the new IA circular. So when it comes to the internal control framework, the insurance authority has provided you with the flexibility to either adopt an internationally recognized framework or to develop one internally. Now, as Siddharth mentioned earlier, the COSO internal control framework is the most widely accepted globally. And even though it was not explicitly mandated by SOX or even Audit in 2017, most organizations have actually adopted the COSO framework. So our recommendation is to adopt COSO primarily because, one, it is internationally accepted. It's a very comprehensive framework, and it's going to save you a significant amount of time because you don't have to recreate a new framework from scratch. You can already take what is already in existence and is widely accepted. So I wanted to spend a little bit of time to give you an overview of the COSO framework. Now, a lot of you may already be familiar with this, so I won't get into a lot of the details, but just to provide you with an overview. So as you can see on the COSO cube on the right-hand side, there are three main objectives. Now, the first objective is operations. Now, when we talk about operations, essentially what we're referring to is we need to ensure that the entity operates effectively and efficiently to achieve its strategic objectives. When it comes to the second objective, which is reporting, we're referring to making sure that the entity issues internal and external reports which are complete, accurate, and timely. So specifically, the IA circular is focusing on this one major objective of internal controls over financial reporting. There's also an additional element that we need to be aware of, and that is the compliance objective. So here, what the COSO framework tries to do is to make sure that the entity carries out its activities in line with applicable rules and regulations. So whilst the focus with the IA circular is primarily on financial reporting, you need to be aware of the fact that both operations and compliance are also very important components and objectives of the COSO framework. Now, as Sid also said, the benefits of implementing internal controls is not just to meet a regulatory requirement, but also to take all of the value-added benefits that the internal control framework would be able to provide to you. Therefore, over a period of time, we do recommend you to, once you focus first on financial controls, but do also try to expand into operations and compliance as well over a period of a few years. Now, the COSO framework also has 5 major components. So these 5 components have also been bifurcated into 17 principles. I won't get into the details of all of the 17 principles today, but I just wanted to provide you with a brief overview of what each of the components are all about. So when we talk about the first one, which is control environment, what we're focusing on here is the tone at the top, the focus on integrity and values and culture of the organization. So this is one of the first things that we normally check when we're doing an internal control review and or implementation. I'll get into the details of that a little bit later on in the presentation. The second component is around a risk assessment. So we need to ensure that the organization has a proper framework in place to identify, assess, prioritize, and manage risks. These risks also include fraud risks. So again, for insurance authority, it's very important that you, as in the insurance sector, have a proper fraud risk management framework in place, not for external fraud, but also internally. The other element is control activities. Now, in control activities, what we want to focus on is make sure that you're identifying, documenting, and implementing controls for all of the risks that you've identified. Now, these controls would be both process risks, process controls, as well as IT controls. And the fourth element is information and communication. So this one focuses on whether appropriate information is shared with external stakeholders as well as internal stakeholders. So this would include whether it's your employees, whether it's your shareholders, the public, or regulators. And lastly, we're looking at monitoring activities. So for monitoring activities, we're focusing on whether you have appropriate mechanisms in place to monitor the performance of the organization, whether it's financial or strategic, but also looking at whether you have the appropriate 3 lines of defense, right? So whether you have an appropriate internal audit function that's objective and independent, do you have a compliance function that monitors the overall compliance of the organization, but also at the senior management level, right? Do you have the right board and the board structures in place, as well as management committees? So that's an overview of the COSO framework. Again, we heavily recommend this framework to be adopted because it will save you a lot of time and it is internationally accepted. So with that, I will request us to go to the next slide, which I want to focus on. And this one, essentially, I wanted to give you a breakdown of the various types of internal controls. Normally, we categorize internal controls into 3 types. So the first element is entity level controls. And the acronym of which would be ELCs. So for ELCs, these are more pervasive in nature and they impact the overall internal control environment in an organization. So even if you have very strong controls at the process level, but you have very weak entity level controls, again, we believe that the overall internal control environment may be compromised. I'll go into further details in this when we talk about entity level controls in specific and exactly what are the expectations of a implementation for ELCs as well as the gap assessments. Process controls are related to a particular class of transactions. So they will be very specific to a particular financial statement line item. And I'll give you an example. So for example, if let's say one of your financial statement line items is gross written premiums. So what we would normally do for that is we know that the gross written premium revenue line item is going to be directly linked to a mega process of underwriting. Now, you may have different lines of business. You may have medical, general, motor, life. So depending on which of those business lines are contributing to the most financially into that financial statement line item, we would focus on the sub-processes of underwriting in that particular business line. So for example, we would look at policy insurance. We will look at revenue recording in your underwriting system, as well as its integration with the financial reporting system. We would also look at the reinsurance allegation that had happened at the time of policy issuance, and obviously the overall accuracy and cutoff in the books of accounts. So that just gives you a flavor of the types of processes that would get in scoped for process controls. Then we also have the third type of control is IT controls. Now here, what we're referring to is we need to make sure, especially in the insurance sector, there's heavy reliance on IT systems in order to generate information, in order to make decisions based on that information as well. So therefore, items that would impact your financial statements based on information which is generated from IT systems normally would have to get captured. So IT general controls are quite an important element of the ICOFR assessment in our reviews. If I can now request my colleague to take us through the next slide. this is a very important slide that I want to focus on because it gets into a little bit more detail around entity level controls. Now, these can be broken down into multiple areas. They range from board and audit committee operations to having an appropriate delegation of authority matrix, having the right 3 lines of defense. Do you have a proper code of conduct, a whistleblowing mechanism, a fraud risk management framework, etc.? So in addition to this circular, we know that the Insurance Authority has also recently published a number of new circulars around AML, KYC, expectations of internal audit, etc. So all of that combined makes ELC so much more important. Now, having worked with a number of insurance clients over the past few years, we know that this area, you may face certain challenges. We have identified certain gaps across the industry on some of these ELCs. And I'll talk to you about some of them so you can have it in mind and maybe you can start thinking about some of the remediation efforts you need to undertake. So let's talk about the delegation of authority matrix. We've noted in a number of instances where a lot of insurance companies do have DOAs in place, but they're primarily focused on finance-related processes such as payments or claim authorization limits. But what we see is that the DOAs are not very comprehensive and they don't cover areas such as the authority granted to individuals for valuation of investments or valuation of reserves. Or for example, if you already have a DOA for your underwriting processes, but there has been a number of instances where we've noted non-compliance with those DOAs. So again, when we're doing an ICOFR assessment, we need to look at the design of controls, but also operating effectiveness. And that's an area that we've seen significant number of challenges in the past. Another great example is if we look at the first area, which is board operations. Now, especially if you're a listed entity, you would know that there have been new corporate governance regulations issued by ESCA that focus heavily on the board composition, on the operations of the audit committee, as well as the other board committees. So ensuring compliance with the new regulations is quite important, as well as the fact that as part of the COSO framework, you need to make sure that you have appropriate board terms of references, their effectiveness, the right training programs, making sure that their level of independence has been justified and you obtain those declarations, etc. So these are all very, very important elements of an ELC program. And another example that I want to give is around the compliance management framework. Now, if you look at the insurance sector, it is a heavily regulated sector, right? You have a number of regulators from Insurance Authority to ESCA to NISA compliance for cybersecurity to AML and KYC regulations by the cabinet, etc. So given that you're heavily regulated, one of the key things we've seen is whilst you have a dedicated compliance function and there may be a compliance policy in place, etc., what we've seen is there isn't a very robust compliance management framework in place. What I mean by that is, do you have all of the applicable regulations in a repository? Have you conducted regular, for example, quarterly compliance tests to make sure that as an organization you have been compliant with the applicable regulations? Have you ensured that if there is any breaches to those regulations, have you reported it effectively to your board audit and compliance committee, as well as to the insurance authority, right? So that framework, in our view, can be significantly enhanced in a number of the insurance sector clientele that we've worked with. So that's just a little bit of a flavor of ELCs in terms of what to expect from implementation, some of the challenges that we've seen, so that you can make sure you focus on that in the next few months. If we can now go on to the next slide. Now here, what I wanted to focus on is what are some of the potential in-scope areas when we conduct an ICOFR assessment. So I've already talked about ELC, so I'm not going to cover that in further detail now. Regardless of the materiality of your financial statement line items, ELCs are almost always going to be included in the scope of work in any case. But what I wanted to focus on here is in the middle of the page where we talk about the core processes and the support processes. Now, potentially, when you're looking at financial statement line items, we need to map that to respective processes in your organization. Now, these could be core or support. So for core, normally what we look at is your underwriting management, your claims management, reinsurance, as well as investments. Now, depending on the lines of businesses that you have and whether they're material to your business, that would depend from one organization to another, right? So you may primarily focus underwriting only in motors, or only in medical, or maybe all of them, because they would all be material to your business. But that is an assessment that we need to do at the first stage. And I'll get into the details of that when I talk about the practical steps that you need to undertake when you're doing a scoping exercise. Now, the other element is the support functions. Now, sometimes support functions are also enablers, and they could potentially also impact your financial statements. I mean, the obvious ones are, let's say, your month-end closing process or the capital reserve process, payroll, etc. But sometimes even sales and business development can also potentially impact the major financial statement line items. And I'll get into the details of that separately with you as well. So that covers the actual core and support processes, which potentially can be in the scope of work for you. Now, IT general controls, as I mentioned, for the insurance sector, it specifically is very important. So from that respect, what we normally see is the scope of work could include access control reviews, program change management, so the entire system development lifecycle of the various applications that you may have, and maybe the Premia system or any other insurance core banking system, your ERP systems, etc., as well as computer operations. So that, again, ITGC, it's very rare if you're doing a COSO implementation exercise for you to disregard IT controls. So that's another area which normally we see in the scope. Now, the next slide that I wanted to talk about is the journey that we normally see organizations adopt when you're implementing ICOFR, assessing the design, the effectiveness, conducting the remediation, and then obviously at the end obtaining the external auditor opinion. So I'll share some of our insights around each one of these stages with you. In my view, the scoping stage, the first stage, is probably the most important phase. The reason for that is because if you don't do this right, you're either going to end up over-scoping, which means you're going to cover all of the processes in an organization, which is not the most effective utilization of your resources. You have costs, and budgets and resources that you need to make sure are focusing on the right areas. And at the other extreme, you may not scope in the key material, processes, which potentially could hurt you by the end of 2021, because if your external auditors believe they're material and you never did an assessment, there may be potential gaps that you would have a blind spot in, right? So finding that right balance is very important. So how do we do the scoping? First thing that you need to do is make sure that you set the criteria for the scoping exercise. So this could include a materiality threshold for financial statements. So in the insurance sector, there isn't any rule or a specific criteria per se, but general standards, we would normally look at either your gross written premium or your total assets. And these could range anywhere between 0.5% to 3% of any one of these two benchmarks. The other element is you can look at your net assets or net underwriting income, right? And again, the percentages change depending on the organization. So that is an area that you need to make sure you focus on in the beginning from a quantitative scoping materiality threshold perspective. Then what we do is we review the trial balance to identify financial statement line items which exceed that materiality threshold, right? If they do, then that means automatically they become in scope for you. But it's not just enough to look at the quantitative elements. We also need to look at the qualitative risk factors. Now, qualitative risk factors can include if a specific financial statement line item includes judgments in determining the recorded amounts, or if there's susceptibility to fraud, or if there's changes in the nature or volume of the underlying transactions over the review period, then those are indications that you also need to include those specific FSLIs into the scope of work. Now, when you're doing the scoping, the next step for you is to make sure that you're mapping that into the respective process. And I already gave an example earlier around process controls. So if you're looking at the gross written premium as a line item, you link that to your underwriting process, which would then get further drilled down into the sub-processes of policy issuance, the reinsurance allocation, the recording of that transaction into your insurance system, as well as the IT general controls in terms of integration with your financial systems. So that's exactly the key processes that would get in scoped for you. The next phase, which is stage 2, here we're looking at documenting and assessing your entity level controls. I've already talked about this in depth, so I won't get into the details of it, but essentially, because no matter what your scoping area will look like, ELCs will always be included in your scope. In order to manage the timelines, you can always get started with ELCs first. So that's normally what we recommend to our clients. So documentation of the ELCs, you could document them in the risk and control matrices, as well as in process narratives. So the assessment, therefore, would also include a review of all of the things that I've already mentioned, whether it's policies, whether it's board meeting minutes to make sure that they're effectively carrying out their duties, whether it's making sure that you have a proper fraud risk management framework, etc. So it's a combination of review of documentation and inquiries with management. Stage 3 gets into the process level controls. So in the process level controls, what we need to do is make sure that we understand and document the as-is processes. What that would entail, basically you need to document all of the processes, including the control descriptions, in process narratives or process flowcharts. Now, there isn't a hard and fast rule about whether you need to document this in process flows or process narratives, as long as the following details are captured, including the who does what, when, and at what frequency into the process narratives, then you're pretty much covered. So once you document the process narratives, you need to obtain confirmation from the respective process owners to make sure that it's fairly accurate. And this is the as-is process, not the to-be, okay? So that would be stage 3. Then we move on to stage 4, which is now you're going to be documenting the controls and conducting the test of design. The test of design ultimately is focusing on whether you have the right controls in place and whether, if you do, have they been designed appropriately or not. So an example of that would be if you have a particular, let's say, claims management policies. 1, does the policy exist? And 2, if it does, is it adequate? Is it updated? Is it in line with the applicable regulations? So those are the key things that we would normally look for in a test of design. Now, when we're documenting controls, another thing that I want to stress on here is, in any process, you may have hundreds of controls in place. You don't necessarily need to document all of those controls. You don't necessarily need to test all of those controls. What's important here is for you to be able to identify key controls. The key controls, if you, let's say, have a risk and you have 5 controls that potentially mitigate that risk, but you don't necessarily need to document all of them. All you need is to document the key control that mitigates that particular risk alone. If you're comfortable with the fact that the risk has been ultimately mitigated, then you can just focus on that control. So that is, again, very important from a scoping perspective, and just to make sure that you're effective and efficient in implementing your ICOFR framework. The next phase would be the test of effectiveness. Now here, if you've already passed your test of design, so it was designed appropriately and there's no gaps related to that, you can proceed to a test of effectiveness, which essentially means we would be selecting samples to assess whether you have consistently implemented the controls. Normally, what we recommend to our clients is, if you, let's say, had a test of design that had a gap or it has failed, there's no need for you to test that for effectiveness, because there's no point. You're testing something that has been designed ineffectively to start off with. So you only want to focus on the areas where the test of design has passed and is satisfactory. When we move on to the next phase, which is the remediation. Now, in my view, the insurance sector needs to focus and give yourself adequate time in the remediation phase. The reason being, now the insurance authority has given you time, right? So by, let's say, by April of 2021 is when you're reporting the 2020 results, you have significant amount of time to remediate those gaps before the end of 2021, when the external auditors are going to come in and provide their opinion. So therefore, make sure that you have allocated sufficient time for that. Once you're remediating the gaps, our recommendation to management is you need to retest the effectiveness just to make sure that the recommendations that were provided have actually been implemented or not. So that's another insight that we wanted to share with you there. And lastly, it's to obtain the external auditor opinion on the ICOFR implementation, which would happen at the end of 2021. So that's an overview of the 7-stage process. Throughout this exercise, one other insight that we wanted to provide to you is make sure that you're providing regular training to all of the key stakeholders. This is new for the insurance sector in the UAE, right? So, and it doesn't only impact the finance function. As finance professionals, I'm sure you're all very much aware of the requirements of ICOFR globally. So this is not very new to you, but to other stakeholders, let's say the head of your underwriting division or claims division or your head of IT, etc., this is all going to be very new. So making them understand why we're doing this, what is the value, and their roles and responsibilities is going to be very key. The other thing that I want to focus on here is this is not a one-time exercise. This is something which is expected by the IA that you would conduct on an ongoing basis. Well, the first year would probably be the most heavy lifting, because if you don't have anything in place, you don't have any documentation, risk and control matrices, you haven't done any assessments, this will be the most difficult year. But thereafter, the effectiveness testing needs to be done on an annual basis in any case. And if there's any changes to your controls, if you introduce a new system, again, your documentation needs to be revamped. So make sure that you have that in mind. And when you're communicating this across the organization and to your respective board and audit committees, this is a regular process. If I can now take you to the next page, which ultimately focuses on the differences between the responsibilities of management and the auditors. So management is ultimately responsible to design, to implement, and to maintain the internal controls in an organization. Now, this is very important to understand, because a lot of times, you know, the implementation potentially, you know, if you want to consider giving it to your external auditors to do, etc., that is absolutely a prohibition based on globally accepted standards, but also the insurance authority has been very explicit about this, right? They've explicitly mentioned that the auditors should not be involved in the process of implementing ICOFR. So we need to manage that potential conflict of interest. So, and I've already mentioned that, you know, management needs to make sure that they are evaluating the operating effectiveness of these ICOFR on an ongoing basis. So that's all we had for the presentation today. I do want to open up the floor now to ask, you know, to answer your questions and also to receive any additional questions.
Look, great. Thanks a lot, Siddharth and Mariam. I think it's been quite useful. I see there are a few questions that have come. So the first one, I think, Mariam, you've sort of covered this as part of your presentation, but if you wanted to add anything further, one of the questions is how insurance companies will do the scoping for selection of their processes and how materiality criteria will be set. I know you've covered that, but if there's anything else that you want to add on that question.
Yeah, definitely. So as I mentioned, the most important element will be to look at the quantitative materiality threshold. So as we mentioned, there's technically 4 different criteria you can use. So there's the gross written premium, there's the net assets, and then also the gross written premium. So essentially you're looking at the percentages would vary. So anywhere between 0.5% to 3% for the gross, and then for net, it would be anywhere between 3% to 10%. Again, this is not set in stone, but that's normally how the materiality threshold is assessed. But the other important element that I mentioned was please pay attention to the qualitative factors. In my experience in implementing ICOFR and working with external auditors, is that a lot of times if we miss the qualitative factors and miss out on in-scope areas, that could come back and bite us at the end of 2021, where we would have missed out on particular gaps that we never even reviewed.
Thanks for that, Mariam. I think let me bring you in. So the question is, what is the role of internal audit department in the ICOFR journey? And also, along with that, if an organization has a strong internal audit function that assesses the internal controls, would that be sufficient or not?
Sure. Thanks, Abbas. So in terms of, first, let me pick up what is the role of the internal audit department in the ICOFR journey. So first, yes, the internal audit department can definitely play a role. But I think what is important to remember first is that this is not something that is the responsibility of internal audit, but it's actually the responsibility of management. right? So what we've seen is primarily this is often led by the CFO, right? And he then brings in the rest of the process owners, rest of the control owners across the organization, because they need to ensure that the controls are working effectively, right, and are in place, right? So now when it comes to, let's say, the role of the internal audit department, and if you have a strong internal audit department, right, so yes, they can definitely help in this exercise, because one, they understand the organization, they definitely understand the internal controls and processes in the company, right? But that said, the challenges that we sometimes find is the internal auditors don't necessarily have bandwidth, right? Because they have an IA plan which is pre-decided, agreed with the audit committee, right? And second, while they understand internal controls, they may not have the expertise on how do you implement a COSO internal control framework, right? So where we've seen the role plays well is sometimes the internal audit head can actually play the role between a consultant, external auditors, as well as the finance team and management, right? Because they can help connect all of these. And also in the remediation, because the consultants will basically do their job, right, in terms of setting the framework, doing the documentation, testing, and identifying the gaps. But then someone needs to make sure that the gaps get remediated, right? So that's again similar to what the internal auditors do in the follow-up exercises, right? So they can actually pick up these gaps and include them in their internal audit gaps and ensure that the company is fixing them on a timely basis.
Sure. Thanks for that, Sid. I'll stick with you, Sid. Another question is, considering this would be an annual requirement?
So I think your voice broke in the middle, but I think you're saying in terms of the cost of compliance, how do you reduce that? So yes, this is going to be an ongoing cost. And what we've noticed is in the initial 1 or 2 years, the cost is quite heavy, depending on, let's say, where you are in the maturity journey, right? So one is to say that you're rolling out the framework for the first time, you're creating the documentation, right? So putting that is one cost, but then we find a lot of companies in terms of the gaps, what we have seen in the region, anywhere between 5% of the key controls fail to as high as 35% of the key controls fail, right? Separately, so then that can have additional costs as well, to say that you do not have a well-documented delegation or authority, or the delegation was last updated 10 years ago, right? So there's a cost in terms of being able to update that. Looking at IT general controls, so let's say you don't have proper segregation of duties in your system, nobody's reviewing the access controls. So putting a formal process around that can also have a cost to it, right? Simple things like policy procedures not defined, that can have a cost in terms of implementing it. So the first couple of years, yes, can be heavy in terms of a cost perspective, right? But thereafter, what we start suggesting to companies to say, as your controls improve, right, you can sort of move away from consultants and go into more of a self-assessment exercise, because you identified your processes, you identified your key controls and control owners. And once you have a comfort that, yes, your number of failed controls are less than, let's say, 5%, you do not have any material gaps, you can then sort of get into a self-assessment cycle to manage the costs.
Sure. Thanks, Ed. I guess we've talked about cost of compliance, and we know the current circumstances, the situation that we are all in. Cost is obviously quite important to manage, right? Mariam, let me just ask you, and these are questions which I've been asked a number of times, and it's also come up in the Q&A here. If you don't comply, are there any penalties?
So at this point in time, the insurance authority has not explicitly mentioned any financial penalties being imposed on the insurance sector if they don't comply. Having said that, they may in the future. So we don't have that clarity at this point in time. But again, I think it's better to be prepared and make sure that you comply as soon as possible before any potential financial penalties are going to be communicated.
Sure, I think that's pretty clear, Mariam. Thanks. Just a follow-up question came on the materiality point, Mariam. Again, just for you, can we apply one materiality level for all FS, all financial statement lines, or would it make sense to apply different materiality levels for different line items?
So normally, we do adopt one, and that just enables us to have a more consistent approach. Having said that, I know we also have NA on the line from an external auditing standpoint, and I think this would be a very good opportunity for him to share his inputs as well. NA, can you just give us some direction on that?
Can you hear me?
Yes.
Yes, Anil.
Yes. Hi, Mariam. Thank you so much for that. Yes, a single view can be taken on an overall materiality level, but then again, as a management view, there could be a broken down further into sub materiality level, depending upon what is the view of the management is on a particular risk factor. So the question is, if a single benchmark can be used, yes, it can be used.
Okay, and I guess, Anil, it depends on situation to situation. At times, single benchmark would make sense, but maybe depending on management's view on the organization, you may even think about different materiality levels for different line items.
Absolutely, Abbas. Absolutely.
Okay. No, that's thanks for that, Anil. Sid, question: how much time commitment is required of a company to perform this entire exercise from scratch internally?
Okay, so let me probably break that up. Jitin, can you move to the slide where we showed the 7 stages so that people can actually see the 7 stages and I can talk through? Yeah, so I think performing the assessment and scoping, this is something that you can probably cover in 1 week's time, right? So what we recommend, and again, we've spoken quite a bit on materiality, but use the materiality that your external auditors are using, because they are the guys who are going to come in at the end and do their independent testing, right? There is no one single definition of materiality, but basically what materiality means is any financial impact which can cause the investors or basically shareholders to change their mind, right? So whether to buy, sell, hold, right? So anything which is material enough to get them to change their mind is the definition of materiality, right? And so the auditor's materiality is what we'll end up using for the quantitative measure. Qualitative is more subjective, right? So where we say there's a risk of fraud, and again, the risk of fraud is, let's say, inversely proportionate to the level of fraud. So a cashier could get away with taking 100,000, and that may not result in a material gap. But if, let's say, the CEO of the company takes even 1,000 or 10,000, that becomes material, because that's now impacting your entity level controls and your tone at the top, right? So while, yes, we look at one materiality, which is what the auditors use and what is accepted by the audit committee, there can be situations where you tend to look at other factors as well, right? So the first stage is basically on scoping. This can be done quickly within a week. We recommend getting some sign off, or at least looking at what the auditor's materiality is. For 2021, you would definitely look at getting the auditors to also sign off on the scoping. The next stage, in terms of documenting and evaluating entity level controls, this roughly takes about a month to do, because you've seen it's fairly pervasive. It covers your finance function, it covers HR, it covers legal, it covers compliance, right? It covers the board mandate. So that takes roughly a month to make sure that you have the framework in place and come up with the missing components or the gaps there. The understanding and documenting as is processes, depending on the complexity of the process, will take between 1 to 2 weeks to get it done, right? And again, maybe 2-3 hours during a day sitting with the process owners to get the mapping and get them to sign off on it. Test of design, basically, thumb rule is, once you've identified the key controls, to do a walkthrough roughly takes an hour per control, right? So basically, you'll end up taking one sample and walking through the entire process. So you could actually, in that one walkthrough, cover multiple controls. So thumb rule is roughly an hour per control. Test of effectiveness requires you to actually pick up a greater sample to make sure the control is working across the period. So depending on the frequency of the control, an annual control happens once a year, you can only test it once. Let's say it's a monthly control, 12 times, you'll test 3 or 4 times. And finally, let's say it's a daily control or multiple times in a day. It could be between 25 to 40 times or samples that you'll pick up, depending on the comfort that you have on the level of control, right? Now, these stages 1 to 5, till you've done your test of design, test of effectiveness, could overall land up taking 3 to 4 months to complete. Then you have to basically stage 6, which is remediation, depends on the quantum of time and what is the level of the issue, right? So that could depend from issue to issue. And then coming finally to the external audit opinion. So we normally recommend that you complete the cycle every year by, let's say, at least October, so that November, December, the external auditors can come in. And in case they do pick up something that you missed out, given the opinion is as of 31st December, it still gives you some time to fix it, so that and then the auditors can at least go back and give you a clean opinion as of 31st December if you've basically taken care of the gap before that, right? So let's say 3 to 4 months of stage 1 to 5. You may need 2 to 3 months for remediation, and then a couple of months at year end for the external auditors.
Thanks, Ed. I guess it goes back to Mariam's earlier comment, how important is stage 1 and stage 2, just to make sure you do make some errors in doing that scoping. I think you may have to bring in, and that 3 to 4 months period could get extended quite significantly. And I don't think anybody can afford that at this stage. Mariam, a question for you. I think it's very well after how Siddharth has just explained the overall sort of stages. What would be the different deliverables that one should expect as an output from this ICOFR exercise?
Okay, no, that's a very valid question. So normally we would expect a scoping document in stage 1 that confirms and you get sign-offs from all of the key stakeholders on what exactly are going to be the in-scope processes. So that's going to be the first deliverable. Then you would need to have process narratives and or process flowcharts. Thirdly, you need your risk and control matrices defined for all of the in-scope areas. And then you also need to be able to demonstrate the test of design and test of operating effectiveness sheets, basically the evidence that has been conducted, which would ultimately result in a gap report as well as a remediation roadmap.
Sure. Thanks, Mariam. Please keep the questions coming. I still have 2 to 3 more questions, but happy to take more as well. So there are a couple of questions around sort of external audit. And I think Sid sort of covered on one of it. So the first question, maybe I'll take that. The question is quite straightforward at the moment, which is what type of report should external auditors are supposed to provide on this, right? So look, I think the final look and feel of what the report would look like for the UAE for this particular insurance sector is still being discussed amongst the big four. It will get discussed. I think the good thing is we have time between now and 31st December 2021, which is when the first external audit opinion will come out. But what we intend to do is once we've had discussions amongst big four, agreed that with the insurance authority, we will arrange another webinar similar to this, just to talk you through what this opinion would look like. And if that has any change to what we've talked about today, I don't anticipate any changes in terms of the approach around ICOFR that we've talked about. But if there is anything, we will absolutely arrange another webinar to talk you through what this external audit report would look like. As an add-on to that question, and Mariam, let me bring you in this. I've been asked this question a few times as well. If we identify significant issues during your sort of ICOFR review, let's say in 2020, and remediate that during the year 2021, but before 31st December 2021, will that help in getting an unqualified opinion for the year ending 31st December 2021?
Yes. So the way it works is, if you read the IA circular carefully, it explicitly mentions that the external audit opinion should be provided as at December 31st, 2021, not during the period. Essentially what that means is if you identify gaps, but you remediate them before December 31st, then there is no need for you to receive a qualified opinion. So therefore, you're safe. So it is, again, going back to what I was mentioning earlier about remediation, making sure that you dedicate sufficient time for that, is because it will help you in obtaining an unqualified opinion by the end of the year.
Sure. And it's going back to Siddharth's earlier point on the 7 stages that you want to make sure you finish stage 6 around sort of September, October time. So even if something does come up, you as an organization have a couple of months to remediate to be able to get an unqualified opinion as at 31st December 2021. One more question. This is quite interesting. I want both of your perspective here, Mariam answer. Mariam, from your insurance sector knowledge perspective, and Siddharth, having done a number of these ICOFR implementation with organizations as a result of Ada Resolution 1. So how prepared are insurers in the UAE, in our opinion, so in your opinion? And do you think that the insurers have enough skills, resources to work on these new requirements?
So if you don't mind, Sid, I'll go first. So from an insurance sector perspective, I believe that there would be significant investments required in the first year, because at this point in time, whilst you have an internal audit function and you have a compliance function, it's quite rare to find an organization that has internal control separately and whether they've implemented this. To be frank, it's only, I would say, the larger entities that, let's say, have their head office in the US or in the UK that have their foreign branches here and they need to adopt an element of internal control frameworks that have something in place. Other than that, locally, I haven't seen much. And if there are, it's very preliminary and basic. So the second part of that question is around the skill sets. I think in the finance function, a lot of the organizations do have the relevant skill sets in order to do this. It's more about capacity. In order for them to really be able to do this justice and do it the right way from the beginning, I think that there would be significant challenges involved. So my recommendation, again, something similar to what we had seen in Ada, was in year one especially, you probably need external support. If you don't have the resources in-house, over a period of time, once you upskill and you train or maybe even hire additional resources, then you'd be able to actually carry this forward in the following years. But year one, I think significant investments would be required.
So just on the same question, thanks, Mariam. Siddharth, just on the same question, maybe not specific on insurance sector, but you've seen just the culture environment in the UAE and how some of the companies who had to comply with ICOFR a couple, 2-3 years ago now, how have they evolved and what did you see were the big challenges for them?
Sure. So let me try and answer that with one of the other, and along with one of the other questions that has come up, saying for 2020, do insurance companies have to provide any updates to external auditors and the insurance authority? So what we've seen is year one is always a challenge, right? So by the time actually the circular comes out and companies actually realize the circular's out and they need to do something about it, most of the year is gone, right? So if you look at 2020 also, we are sitting in November today, right? And most companies would have just in the last couple of weeks started understanding what the requirements are. And this is where we've also then engaged with insurance authority and given them the challenges we've seen globally. So every time the first year is fairly messy and chaotic, right? So insurance authority, therefore, in their wisdom, have been sensible enough to say that for the first year, they are giving companies time till end of April to actually implement. So you've got 4 to 5 months to actually do what is required in terms of documentation and the first level of testing, right? What we also do in the first year is spend a lot of time training the process owners. But honestly, the first year, I would not expect more than 30-40% of what is required people to actually understand, right? It's only in the second year when the people are doing the second cycle, they start understanding better. This is what the requirement is. This is what is expected from us. What is the implication of a key control failing, right? What is the implication of landing up with a qualification, right? Because this is now a second opinion which is going to come from the external auditors. You're going to have multiple people looking at this opinion, right? And maybe we can touch upon it, but you can have cases where you can have an unqualified financial statements, right? Or the opinion on your financial statements, and you can yet have qualifications on your internal controls around financial reporting, right? So they are two very different things. So the way I like to explain it in simple layman's terms is to say that the auditors come in, let's say, check your depreciation calculation and the depreciation calculation is incorrect, right? They go back, get management to correct it, financial statements are perfect, true and fair view, no problem in getting that opinion. But if they feel that the process of depreciation was incorrect and which is why management wasn't able to calculate it, they can actually give you a qualification on internal controls around depreciation. Similarly, it could be around sales cutoff, it could be around the IT general controls, right? So this is now, and that's where people will start questioning, the audit committees will start questioning. So the good part is we have 2 years for 2020 to do it first time internally. But yes, the insurance authorities also asked for the report, but they've said only key gaps have to be highlighted in that report. And then you have the whole of 2021 to fix that, so that at the end of the year, you don't land up with a qualification.
So Siddharth, I think you sort of answered the other question as well around do insurance companies have to provide updates to external audit insurance authorities? I think it's clear that it'll be beneficial for them to keep their external auditors as involved as part of their journey. But what needs to be or at least submitted to the insurance authority is not an opinion from the external auditor, but in terms of where they've got to with their implementation and what their key gaps are as far as the ICOFR process is concerned. Is that correct?
Yes, absolutely.
Okay, great. I think another question, again, on the external auditor's opinion. I think it'll be very difficult for me to commit to anything as to what the external audit opinion is going to look like from an insurance authority ICOFR perspective. But just to give you a sense, let me bring in Siddharth here around, because he's been involved and other resolution 1 has resulted in such opinions which have been done by external auditors. Siddharth, can you maybe just cover, not insurance, obviously we can't comment on what the final report will look like for the insurance sector because there's still discussions ongoing amongst Big Four, and we'll go back to this group later on. But based on what you've seen as a result of other resolution 1, can you talk about what the look and feel of the opinion would look like?
Yes, so I think most of the Big Four are using ISA 3000 in terms of the standard for conducting the audit and giving an opinion on the internal controls. So largely what the opinion has is talking about saying that they've looked at the internal controls and either they're satisfied with the internal controls, or if not, they would mention where the material weaknesses lie, right? So we've seen challenges around, let's say, fixed asset verification not being done. We've seen issues around intercompany, as I mentioned, IT general controls, segregation, access controls. So these could be some of the things which result in qualification, which comes, let's say, at the face of the opinion. And then what we've seen is basically an annexure with, let's say, the significant or let's say the non-material deficiencies coming in an annexure where the auditors then list down a number of other gaps as well, right? So just to elaborate on that, we basically break up gaps into 3 types. One is material. So let's say the impact of the gap could be more than the materiality, which is defined by the auditors, right? So that will result in a qualification. Then if it's less than the materiality, but more than 50% of the materiality, right? So half the materiality, that's called a significant gap. So that's sort of addressed separately. And then it could be just a controlled efficiency, which is, let's say, less than 50% of the materiality, right? So those are the 3 buckets. However, if you have, let's say, a number of significant deficiencies, which cumulatively still result in a qualification because they could still have a cumulative impact, which is material, right? So that's what we generally see in terms of the opinion.
Great, thanks, Sid. I guess this brings us to our final question, and Mariam, this is for you. Is this ICOFR requirement only for insurance companies, or is it also applicable on insurance-related professions such as brokers, agents, etc.?
Right, so the Insurance Authority circular is quite specific about this, and they've explicitly mentioned it's applicable on all insurance companies registered and licensed by the IA. So based on that definition, it's only insurance companies and not brokers or agents.
Great, thanks for that. Look, I think that brings us to an end of questions, unless I've missed any. I don't think I have, but I think it brings us to an end to all questions. Look, if you still have questions, the contact details are in front of you. This presentation will also be circulated, so you'll have the relevant details. If something does come to mind, please feel free and get in touch with any one of the people that you can see on the screen. But with that, let me just hand over to Mariam and Siddharth for any final comments before we close out. Mariam?
Sure. So thank you for that, Abbas, and thank you all for joining today. I think as a final comment, look, the reason why this is all happening is because if you look at the overall regulatory landscape in the UAE, the UAE as a government is trying to elevate its corporate governance, its compliance framework, its internal control framework, etc. And the primary reason for that is because, they want to attract foreign direct investment into the country. So this is not going to be the only regulation that you will see. This is just the start. So when it comes to ICOFR, the earlier you actually start implementing it, the better it will be for you, because it is a long journey. So, if you have any questions around this, feel free to contact us. Happy to share our insights with you. But my lessons learned from all of the SOX implementation projects I've done, as well as Auto Resolution 1 projects, is get in contact earlier than later. This will take a little bit of time.
Sid?
Yeah, thanks, Abbas, and thank you, Mariam. So I think just closing remarks from my side. So thank you for everyone who's actually attended the WebEx. Right, so it's been a pleasure to connect with you. And if you want to connect with any of us individually, I think we are more than happy to have one-on-one sessions as well. And yes, as Mariam said, this is something which was bound to come sooner or later. We know there are companies which are getting hit by multiple regulators, right? So, and we know that there are other regulators also currently looking at similar enactments where they are planning, whether it's separately in Dubai or for ESCA, right? So this is something which is coming, and many countries are implementing this across. So yes, we've done this before. It can be a little difficult in the year one, but I know most CFOs that I've interacted with have actually said this is hugely helped them in doing their jobs, because you have a lot less errors, you have better processes, better controls, and things then definitely move more smoothly within organizations. Yeah.
Great, thanks, Sid. Look, I'll keep this brief. Thank you to both Mariam and Siddharth for sharing their insights. Thank you to all of you for attending this session. Please, as both of them have said, reach out to us if there's any further clarification, any support you may need. We do intend to hold a few of these webinars as things become more clearer within the insurance sector, not just focus on ICOFR. Please, we look forward to getting any feedback from you. Feel free, drop us a note as well, any interesting topics that you might want to hear of in the future. With that, thank you so much, and enjoy the rest of the evening.
Thank you.
Thank you.